have seen recently Ray Dalio, who's the CEO of Bridgewater's the largest hedge fund in the world, has come out and said he thinks it's late. We're already in the late cycle. He called it the seventh inning, and he's preparing his business for that turn. What's interesting is some of the traditional leading indicators of economic change don't seem to be applicable today, and so we're looking for other indicators to tell us where we are. Stock market's a perfect example. You know, there's been a 46% drop in the number of actual public firms in the United States since a peak in 1997, or 8,700 firms in 1987. They're just down to 4,300 firms now. Unfortunately, I look out at the tables and see that there's a lot of baby boomers out there, and we're the ones that have been pouring money into 401ks, and all that money goes in the stock market. So we got a supply-demand imbalance within the 4,300 stocks that are out there, and so I don't believe the stock market will be an early indicator of a change in the economy. It'll be late to the game. Doesn't mean it won't be a serious drop when it comes, but we're not looking to that to be to give us any insight at this point in time. Leveraged loan markets, the next thing. That was the last bust in 2008, 2009. We got some ugly numbers up here. 73% of GDP for debt at non-financial companies in the U.S. Leveraged loans now just passed high yield loans in actual dollar amount outstanding at 1.36 trillion. Moody's says 80% of those are covenant light. That's kind of critical because covenants is how we get defaults, and if there aren't any covenants, then we don't get defaults, and if we don't have defaults, then we don't have the indicator of coming distress. The other interesting fact is it's like a barbell, right? So we got all this debt out there that's tied to these leveraged loans, and then we've got basically the S&P 500 now has a $1.2 trillion of cash on the balance sheet, $2 trillion in total cash on corporate balance sheets. So with all that information, we've got a projection that default rates are actually going to drop from 3.9 to 1.7, which would indicate that the economy's doing better, which I don't think is our view of the world. So this also turns out to not be a good indicator. So what do we look to? Unfortunately, one of the key things is back to the baby boomers. That economic growth is based on employment, productivity, and capital. What we've seen is in the 70s we had 2.6% annual growth in employment. Today we're at about 0.2%. Roughly 10,000 baby boomers are turning 65 every day, and that's going to continue for the next 19 years. So the Bureau of Labor Statistics came out in last October and said there's 11.5 million new jobs that are going to be created over the next 8 years, and there'll be less than a million new people to fill those jobs. So there's going to be a supply-demand imbalance here, which is likely going to lead to wage inflation, which is likely going to start the next cycle. You don't have to pick up the paper without reading about 26% tariffs on God only knows how much goods from China we're going to end up with. That's real cost. We're seeing in our business right now companies basically trying to address that. It's still early in the process, and I don't think we're seeing a lot of companies that are feeling the full effect of that. Apple has their big announcement today, and they've already come out and said if they aren't changed, they're going to raise their prices on their products this year, just based on the tariffs. The effect of that is there's a lot of good, solid businesses out there that have slowed down their capital spending because of the uncertainty of what that means. We have a client that doesn't know if they want to build a plant in China or a plant in South Korea, and they can't figure out who's going to have the better trade package if they do. Oil is also hanging out there. We've seen in Texas, it's on everyone's mind. It's kind of stayed out of the limelight for the time being, but we're spending a lot of money drilling fracking wells in the shale plays, and there's a belief that we're building huge reserves and that those reserves are justifying the cost. But if you look at the billions of dollars going in versus the value coming out, it's not 100% accurate to say that we have a firm understanding of that ultimate trade-off. And as we know with the Middle East, one small political problem can have a big impact on oil costs, which then affect energy costs and other inputs into production. Finally, we get to yield, to interest rates. We're right now at the smallest differential between the 10-year treasuries and the 2-year treasuries. That indicates it's a flattening yield curve. Over the last 50 years, any recession has been preceded 8 to 10 months by a flattening or an inversion of the yield curve. So all of this, I think, tells us that we're still not there yet. And depending on your politics, you can say things are rosy or things are less than that. But from our perspective, because half of what we do at NTA Riverbend is distress and half of it's healthy, we're seeing a whole lot more distress. So I go to the anecdotal evidence. We're seeing banks that are right now starting to push the weaker clients out, trying to find unregistered or unregulated asset-based lenders to pick them up. And unfortunately, if you're a weaker client, there aren't a whole lot of people jumping up to try to lend to you, as it turns out. Every day there's a new credit fund being announced that wants to be a lender of last resort and get 18 to 22% interest for first lien debt. It's just not a sustainable business strategy. There's a lot of good companies that are being pushed into these deals, and it's just a temporary holding spot until they lose their business. Merchant cash advances. New York is a wonderful state, but they have no usury laws for corporate loans over $2 million. And we're seeing a lot of trash coming out of New York right now. So if your business is in trouble and you have to make payroll, you can go online and borrow $200,000 from a merchant cash advance lender and get through your payroll. But you basically sign a document that says you won't fight in a foreclosure or litigation when they come to take over your company. So it's a bad setup, and we're seeing more and more of that come into decent companies that shouldn't be there. The other thing is for the longest time, bank credit agreements were pretty standard documents, and you knew what you were going to find in those documents from a covenant perspective and a structure perspective. We're all of a sudden starting to see some crazy stuff like a multiple of invested capital covenant that says that the lender gets a 1.6 times return on their money regardless of what the interest rate and fees are over a period less than 2 years, which again in Texas is usurious, but under New York law it isn't. There seems to be a total disconnect in the risk-return trade-off. I spend a lot of time talking to lenders that say if I can't get 22% interest, I can't accept that risk, which is 100% collateral coverage from a traditional borrowing base. And last but not least, lender liability for the time being. Texas has always been kind of, unfortunately, on the forefront of lender liability due to the FARA case back in the late 80s, as it turns out. But we're seeing a lot of banks that no longer pay attention to what their potential liabilities are in dealing with distressed companies. And my expectation is sometime in the next 18 to 24 months, we're going to see somebody step over the line and get back into trouble from that perspective. So to sum this up, I would say that we're versus being in the 7th inning, I think we're stretching and getting ready for the next game. It doesn't look like something that can be reversed. I don't think that, you know, when it happens, everyone's gonna come out and say, I saw it coming. Unfortunately, I went to Cache a year ago and I thought I saw it coming, and